Welcome back to the Deep Dive, the place where we cut through the noise and give you the comprehensive, evidence-based analysis you need. Today, we're doing a deep dive into Hindware Home Innovation Limited, or HHIL, a key player in India's, highly competitive building and consumer products market.
And it's a particularly fascinating time to look at HHIL. I mean, we aren't just analyzing a steady-state business here. We are looking at a company that's undergoing a major, deliberate strategic upheaval. They are mid-restructuring, and their recent pivots, the cleanup, are making their short-term financials look, frankly, a bit messy. So our mission today is to break down their complex, diversified core, dissect the financial volatility we see between FY23 and Q2 FY26, and provide you with a clear, balanced synthesis of the upsides and, the very real risk based purely on the latest available data.
That clarity is exactly what you, our listener, came for. So before we unpack the numbers and the strategy driving this turnaround, if you find this structured, evidence-based analysis valuable, please just take a moment right now to like, share, and subscribe. Also, make sure to click that bell icon. That way, information related to new deep dives reaches you immediately. Now, let's get started with the structure of this business. Okay, let's unpack this. We're looking at a diversified company that sells everything from premium sanitaryware to plastic pipes. What exactly are the two core businesses that drive HHL, and why is it structured this way?
Well, HIL is fundamentally split into two segments, but the complexity really stems from the fact that they are actively trying to separate these two engines to unlock, better value. The first, and traditionally the largest segment, is building products. This core business is run through their unlisted subsidiary, Hindware Limited. This includes the high-brand recall segment of bathware, so that's your Sanitaryware, Faucets, and wellness products, as well as premium tiles. And importantly, it also includes plastic pipes and fittings, which are branded as TrueFlow by Hindware.
And the second segment is lighter.
Yes, exactly. That's the consumer appliances business. They've aggressively rationalized this segment to focus on the profitable categories. Kitchen and home appliances under Hindware Smart Appliances, which is primarily chimneys and hobs. Plus, they run a crucial 50% joint venture, Hintastica Private Limited, which manufactures water heaters. The whole strategy really revolves around splitting the capital-heavy, high-potential pipes business from the mature, stable bathware business.
Okay, so when we look at this combined structure, what gives them a competitive edge or a moat that makes it hard for rivals to compete?
The sources highlight 5 key advantages, and they're all really rooted in legacy and distribution. Number 1 is the decades of strong brand trust and recall. I mean, everyone in India knows the Hindware name. 2 and 3 relate to the product experience. Strict quality control and prompt after-sales service.
But the network must be the biggest piece, right?
It's arguably the most powerful moat, yes. Their extensive distribution network, they have over 600 exclusive brand stores, they partner with 500 distributors, and they reach 35,000 retailers nationwide. And crucially, the TrueFlow Pipes segment has built these deep relationships with skilled labor, maintaining a database of over 100,000 plumbers. In the construction supply chain, that kind of trust and reach is, it's priceless.
That strong brand foundation is essential, but now let's see how that translates to the profit and loss statement. We're looking at a company in flux. What story does the top line, the revenue tell, especially in the last few years?
The top line shows volatility and a pretty noticeable slowdown in momentum leading up to their strategic shift. After posting strong consolidated revenue of 2,872 CR in FY23, sales actually contracted in FY24 to 2,776 CR, and then continued to decline in FY25 to 2,523 CR. Currently, the trailing 12-month, or TTM, revenue is sitting at 2,501 CR.
Hold on a second. We heard that the TrueFlow Pipes segment is cited as India's fastest-growing brand in that space. If that's true, how can the overall sales growth over 5 years be a rather poor 9.36%? Does this imply the legacy bathware business is seriously dragging down the entire top line?
That's the exact question the volatility raises. It really suggests that the growth in new areas, particularly TrueFlow, is being significantly offset by challenges, rationalization, or maybe saturation in other legacy product lines. And that's forced management to make some harsh strategic calls to stabilize the overall profitability.
Let's discuss that operational profitability. How is their EBITDA tracking?
Right, so EBITDA, or earnings before interest, tax, depreciation, and amortization. It's the metric for true operational profit before you account for non-cash expenses. And here we see some serious margin compression. Their consolidated operating profit margin, or OPM, it dipped noticeably from 9% in FY24 down to 6% in FY25. Ouch. It is. But the positive spin is that the latest results for H1 FY26 show recovery to around 9.7%, which suggests that the management's recent operational cleanup is starting to restore some margin health.
Let's talk about that cleanup because it seems like it heavily impacted the bottom line, PAT or profit after tax. What caused the recent losses?
The net profit has swung severely into the red. It moved to consolidated losses of nearly 68 CR in FY25 and 93 CR on a TTM basis. This negative bottom line figure, it looks ugly, but it's so important to understand the context here. It's directly influenced by a major deliberate action. This significant exceptional loss of 49.49 CR that they recorded in Q1 FY26.
So this wasn't just poor sales.
No, not at all. This was a calculated financial reset. Imagine management deciding to clean out a corporate garage full of old, broken, unprofitable inventory. They took a massive one-time write-off on all those consumer product categories like fans, water purifiers, and general trade air coolers that they had decided they just couldn't sell profitably anymore.
So they took the hit all at once.
Exactly. That painful nearly 50 CR loss is essentially an investment in future margin stability. They paid a price today to guarantee a better P&L tomorrow.
Okay, so the profitability looks intentionally messy because of the cleanup, but messy profit is one thing, messy debt is another. Let's look at the financial foundation. Has this restructuring left their balance sheet shaky?
The debt load is a serious point of concern. The consolidated net bank debt has been increasing. It rose from 692 CR in March 2025 up to the 746 CR in September 2025. Now, management points out that this increase is necessary. They attribute it primarily to investment capex in the new rookie pipes plant and, crucially, higher working capital days.
That working capital seems like a growing systemic problem, especially with that higher debt. What exactly is stretching the working capital cycle?
The sources flag both components of the cycle pretty clearly. First, debtor days, so how long it takes customers to pay them, have increased from a historical 60.4 days to 73.5 days. Second, and much more drastically, inventory days reached an alarming 311 days in March 2025.
311 days. That's almost a full year of product just sitting in a warehouse. That's not just a line item on the balance sheet. That's a massive mountain of physical goods, pipes, fittings, bathroom sets that represents locked capital.
It's exactly that. And this results in a chronically high cash conversion cycle, which was sitting at 174 days for FY25. High debt, combined with this massive amount of capital tied up in inventory and receivables. It just points to an operational inefficiency that demands immediate attention. If capital is locked up, they have to borrow to fund new growth.
Right. Shifting to cash flow, does the reported operational profit turn into actual cash that pays down that debt?
Generally, yes. The operating cash flow, or CFO, it remained robust at 241 CR in FY24, although it did moderate slightly to 192 CR in FY25. So historically, they're pretty good at converting accounting profit into cash. However, the recent debt increase confirms that internal cash generation just hasn't been enough to cover the recent heavy expansion capex, like the new pipes plant. The good news is management has publicly targeted reducing debt by 60-70 CR in FY26, and they aim to become debt-free in 45 years via internal accruals, assuming, of course, the new strategy pays off.
Let's get to the high-level efficiency check. When we look at return on capital employed, or ROCE, and return on equity, or ROE, how efficiently has HHL been using the money invested by shareholders and lenders?
This is where the story gets really dramatic because the ratios show significant historical stress. Let's start with ROCE. This measures how well the company uses all its capital, so borrowed and owner's money. It has collapsed. It fell from a high of 22% back in FY21 down to a meager 3.62% on a TTM basis.
3.62%, wow, that is dangerously low. What is that number telling us?
It's the market screaming that the massive capital they just deployed is, well, sitting idle. That huge investment in the new rookie plant, for example, is not yet generating sufficient operational returns. It's an asset deployed, but not yet fully utilized or commercialized. So this low ROCE figure is a temporary structural issue related to the investment cycle, but it confirms poor efficiency relative to the capital deployed right now.
So the whole turnaround depends on this number.
The entire success of the turnaround hinges on turning that 3.60% into a stable double-digit return, and fast.
And what about the shareholder return metric, the ROE?
The ROE shows a profit generated per rupee of shareholder funds. Unsurprisingly, due to the recent PAT losses and the exceptional loss items we talked about, the TTM ROE is currently negative at negative 6.46%. The three-year average is barely positive at 2.1%. These metrics are just historically weak and require urgent repair.
Do the sources provide clear steps on how management expects to correct these efficiency ratios?
Absolutely. The strategic pivot exiting those loss-making businesses is explicitly cited as the foundation for margin recovery. Their goal is to fully utilize new capacity and drive premiumization in bathware to restore margins to the mid-teens. If they hit those margin targets, the ROCE and ROE will necessarily rebound. And that will prove that the recent CapEx was a shrewd investment, not a debt-funded mistake.
Okay, strategy is where the future value is created. So what are the major growth drivers the management is pushing to lift those margins and returns, and what specific risks should you be monitoring?
The overarching strategy is one of concentration and premiumization. In bathware, the strategic focus is entirely on the mid-premium and premium products, which now account for half of their Q2 FY26 sales. They're aiming for a growth rate of 1.25x to 1.5x the market growth, and they are aggressively chasing institutional sales, targeting 15-20% growth in that B2B segment.
Let's focus on the pipes business, TrueFlow. That new capacity coming online, like the Rookie plant, that seems to be a key bet here.
It is the central piece of the expansion puzzle. The Rookie plant, with 12,500 tons of capacity, will commercialize in H2 FY26. This is crucial because it gives them access to the key North Indian market, which is massive, and allows them to offset those crushing south-to-north freight costs involved in moving bulky plastic pipes. They're also launching high-value niche products like specialized foam core and fire sprinkler systems that target very strong 30% to 32% gross margins.
And for the consumer appliances segment,
Strict profitability. The focus is on targeting sharp 10-12% EBITDA margins in the next financial year for this segment, leveraging their strength in kitchen chimneys and hobs for efficient cross-selling.
okay, now for the red flags, the risks that could derail this whole recovery plan.
There are four major risks. First and foremost is the complex restructuring uncertainty. The entire thesis of unlocking value relies on this composite scheme of arrangement, which will result in two separately listed companies. The application is still with the NCLT Kolkata, and management estimates this prolonged legal process will take 8 to 12 months. That lengthy timeline creates major regulatory and structural uncertainty for investors.
A lot can happen in 8 to 12 months.
A lot can. Second, the pipes business is highly volatile. We saw this when the segment faced a steep 21% volume decline in Q1 FY26. That drop was caused by sharp raw material price drops, specifically PVC-CPVC, which forced dealers to destock. Volume growth is therefore highly sensitive to commodity price stability, which they just can't control.
That strong push into institutional sales also seems risky. 400 basis points lower in margins is a huge swing. Why is the management leaning so heavily into institutional sales if the margin is so poor? Are they just buying market share to keep new capacity running?
That's the tension, exactly. Management confirms institutional margins are about 400 basis points lower than general trade. It is a necessary evil right now. Institutional sales provide the bulk and predictability needed to ensure new capacities, like the Rookie plant, are utilized. But as B2B share increases, it will inevitably pressure consolidated margins unless they can successfully push premiumization within that channel. And finally, the low efficiency ratios, that 3.62% ROCE and negative ROE, they remain a severe operational concern that has to be reversed quickly once those investments stabilize.
We've covered a huge amount of ground, from the nuts and bolts of their operational structure to their precarious financial positioning and their future bets on premiumization and expansion. So what does this all mean for the informed investor?
Right. Based purely on the strategic and financial data we analyzed, here is a balanced synthesis of HHIL's current position. A company that has, intentionally endured short-term pain for long-term strategic gain. The three biggest positives, the upside are: number one, strategic margin reset. The bold decision to exit high loss-making consumer categories is explicitly designed to stabilize and improve future profitability, targeting aggressive 10-12% EBITDA in consumer appliances and mid-teens in bathware. Two, capacity expansion and portfolio diversification. New, high-margin niche pipe products combined with the strategic Rookie pipes plan immediately unlock access to the key North Indian market and resolve those chronic freight cost issues. And three, brand strength and premiumization success. The bathware segment is successfully focusing on the premium market. It's showing results, with new product introductions accounting for 33% of recent sales. They are genuinely gaining counter share where it matters most in weighted dealers.
Okay, and the flip side, the risks.
The three most significant negatives, the risk factors are: first, low efficiency ratios and high working capital. Current returns on capital are just inadequate. That ROCE TTM at 3.62%, the negative ROE. And this is compounded by high consolidated debt tied directly to a prolonged working capital cycle, marked by those increasing inventory and debtor days. Second is the regulatory uncertainty from the demerger. The core thesis of unlocking value through the twin listing is basically hostage to the NCLT approval process, which could take up to a year. That creates a long period of corporate structural uncertainty. And third, pipes business volatility. The TrueFlow segment is highly sensitive to raw material price swings, and we saw that with a massive 21% volume degrowth in Q1 FY26. This indicates that strong, stable revenue performance is just not assured, even with new capacity available.
This deep dive really paints a picture of a company in a critical transition cleaning house, investing heavily for future capacity and betting on premiumization. But they are currently facing some immediate headwinds in operational returns and the ongoing complexity of the regulatory demerger.
I think that's right. The ultimate long-term success of this strategy hinges on something we can't analyze yet. Whether the new, leaner, capital-intensive pipes business can deliver stable, predictable margins once the Roorkee plant is fully ramped up, and if those new margins can efficiently offset the long working capital cycles of both the pipes and bathware segments, that is the leverage HHIL must prove it can pull off in the next few quarters.
And that's our deep dive into Hindware Home Innovation Limited. If you found the level of detail and analysis valuable to your research, please hit that like button, share this deep dive with your network, and don't forget to subscribe and click the bell icon for more expert-led deep dives. We appreciate your time and your trust in our analysis.